Hey guys, RC Peck here with Fearless Wealth. I want to start this conversation off this week with this picture. Um, when I saw this, I was like, "Wow, that we're not going back to that type of behavior anytime soon." And it's not just Manhattan, right? Major cities around the planet. I immediately, actually, when I saw this, it looks like Manhattan, but I actually thought of the Japanese Tokyo, the Tokyo subway system, where they actually hire pushers to push people in. And I think, what's the long term effect of just however long it's going to take for us being allowed to get into a subway like this ever again? Does everyone have to have masks? Does everyone have to have gloves? Does the subway system get shut down? Not just in New York, but Tokyo, Singapore, Hong Kong, Turkey, or Istanbul. Yep, they have one. Um, like the things that are just the ripple effects that are going to come from this COVID crisis. I don't know what they're all going to be, but I know if we can be long plexiglass, we can be bullish plexiglass. I'm definitely bullish plexiglass. I was at the post office. They actually had two layers. They had two layers of plexiglass. I was like, I don't know how the droplet's going to get around one and then get around the other one. Um, but I just think of all the long-term consequences, right? We've got 30 million people unemployed. There's 156 million people in the workforce in the US. So right now we're right about 20%-ish on just the unemployment number. But I just saw this. I was like, wow, the things that we don't understand yet. The next one was this chart. I thought this was interesting, and we're gonna look at a bunch of different things here, but I want to get a couple of these, just kind of plant the seeds. So this is Starbucks. This is Q1 2020, and they dropped just a little bit right here. They dropped. Let's just call it. It's not even, but let's call it 5%. Here's what's crazy about this. The economy was basically shut down for 15% of Q1, and Starbucks only fell. This is same store sales. I'm going to call it. It's probably more like 4%. So the fact that same store sales only fell 4% when the economy was shut down for 2 out of the 13 weeks, which is 15%. I thought that was pretty interesting. Kind of pretty amazing, right? And I understand you can still drive through to pick up your Starbucks, but it'll be interesting to see what happens for Q2, where it's not just going to be 2 weeks. For sure, it's going to be 4 completely shut down, and you can't go in store. And it's not a conversation about Starbucks. It's a conversation about behavior when things start to open up again. I got a chuckle when I heard that Governor Inslee, living in the great state of Washington, he was allowing hunting and golfing. So it's fishing, hunting, golfing, and the hiking trails. And I just thought the Venn diagram of hunters and golfers, you never thought there was going to be a crossover. So look, this market, this economy, this has been extremely stressful. And I must have spent 2 hours this morning figuring out my 9-year-old software platform. Like, first of all, I don't really like, I do like technology, but figuring out a third grader software technology platform and how they have math on one, English on another, using Microsoft Teams on yet another one, it is just a nightmare. And it's very stressful, because then I load up how I was in school, and school is very difficult for me because I have a dyslexic brain. But here's what's interesting. I just want to read this to you. In the last 4 weeks, we had the COVID-19 pandemic. The world economy shuts down. OPEC blows up. Okay. Worst GDP print since the Great Depression. 6 million unemployed claims. That was just that week in this 4 weeks. But WTI, West Texas Intermediate Crude, goes negative $38 a barrel, right? And Q1 2020 earnings per share is missing by 20%. That's just some of them, right? And so people are like, how can this possibly be? How can this possibly be? And the answer is this chart right here. Now, this is the Fed expanding their balance sheet. All the blue stuff, and it's much wider because that's how long it took the Fed during the global financial crisis to expand their balance sheet by all the blue. So the blue, the length of it is the time. So notice comparing the blue, which is much wider and shorter, and comparing the red, which is almost immediate and what kind of almost looks like twice as tall. So the narrower and taller means the stronger and faster the Fed reacted. And this was the whole point of my email this week. If you're not on my email list, please go ahead and subscribe to the channel. And also, there's a link pinned to the top of the comments where not only you'll learn about how diversification's hurting you, but you'll also get on my list so you'll get the email. But the email I wrote this week was how Title IX changed the world in so many ways. But Title IX was a law that passed in 1972. I can't believe it was 48 years ago, if I'm doing the math right. 58 years ago? Yeah, 58 years ago. That is amazing. It basically gave equal funding to girls or women's sports, to any school that received federal funding, as men's sports got. So if men's sports got $1 million in funding, women's sports had to get $1 million in funding. But it was about equality. And I really like equality. And being raised by 3 women, you get to be on the front line of understanding female equality when you're raised in a household of women. So this is what's going on. The Fed is printing or is expanding their balance sheet like never before. And when they expand their balance sheet, they protect the big corporations, not even the small ones, right? Just the really big ones. And so the whole idea behind Title IX being moved over to Fed balance sheet expansion is when they expand, and let's say they expand by 2.3 trillion, I'm going from memory on what they expanded, the same amount would be sent to every person in the United States over the age of 21. And with this expansion right here, that would send everyone about a $17,000 check. It would just get sent to everyone. If you're over 21, you get a $17,000 check. And so to me, that would be like the Title IX Fed balance sheet expansion. But the red bars there, that almost looks like the Sears Tower, which I know is now called the Willis Tower. That's why the market's going up. It's not because the economy turned around. It's not because we've figured out a lot of things. It's because there's just such an incredible amount of money printing, QE, whatever you want to call it. It is an expansion of the Fed's balance sheet. And guys, it's not just the Fed's expansion. We got the European Central Bank. We got Japan doing the same thing, China doing the same thing, the UK doing the same thing, and us. You add up those 5 parts of the world and you basically have 90% of the world's economy. So pretty crazy what's going on. Okay, so what I want to do is I want to talk about, I have the Nasdaq up here, but actually not the Nasdaq. I want to talk first about Germany. So I got a call from a friend. I have some friends who are financial advisors. We almost never talk about my approach to training people compared to their approach. But he called me, and one of his clients was worried because he was in the stock market. And my friend said to his client, goes, "Don't worry, we have you in a well-diversified portfolio, and Germany is managing this better, and Europe's managing this so much better." And his client was really happy, like kind of relieved, like, "Oh God, thank God we have exposure to Germany and Europe and other parts of the globe," because he was worried how bad it would affect his portfolio if he only had US stocks. So this is the problem when you think in words, right? His client was worried. And on the screen here, I have the German stock market. Now I can actually literally just put the DAX on here, which is the German stock market, but it's the same thing. And I want to point out a couple things. One, the German stock market is doing horrible. It just recently broke above the 2018 lows. So that's a positive for this whole correction. It just broke above the 2018 lows. But if you compare that to the crappy response that the US has had, the US's 2018 lows are here. Now remember, Germany is just getting back above it here. And look at where the US is, it's way above it right here. So it's such a great example of how when we're caught in words and we're caught in stories and you can't counter the stories with a price chart, it really hurts you. So One of the things I'm watching is for the S&P, and I'll do it a couple different ways. Actually, I'm going to use SPY BNB. So this price chart where you're looking at right now, this is the S&P 500 with dividends reinvested being divided by the US bond market. So if the black line is going higher, that means the stock market's the place to be. If the black line is falling, it means the US bond market is the place to be. And so what's interesting about this, because I've shared other divergence indicators, and this isn't a divergence indicator, this is basically comparing the two places on the planet people put their money, or the two places on the planet Americans or people who are paid in dollars put it. They can either put it in the stock market or they can put it in the bond market. So what I find interesting is, and look at this, the stock market was breaking below, it was trying to hit this ratio. Actually, let me just do this. Let me hide this. I always forget to hide this. Let me just do this. I want to annotate this. So as I annotate it, I can just show you what I'm talking about here, and I don't have to hold my cursor there. So the S&P broke above this ratio and stayed above it. It broke down below very quickly in 18, got right back up. Why? Because Jerome Powell said, I won't raise interest rates 3 times in 2019. I'll lower them. That was the big deal. Okay, so it stayed above. And then it absolutely crashed through it. There was a little bit of a jiggle here, but now it's right back in that. So here's the question to me. Based on, and this is a pretty important ratio. So now if the black line is below the red, that means bonds are winning the arm wrestle, okay, or the arm wrestling. And if the black line is above, that means US stocks, the broad market measurement of US stocks is winning. So we're really at this place where, okay, what's going to happen? Is the black line going to come back down? If it does, that means the US stock market's going to weaken relative to the US bond market. So this is a big test that's in play right now. It's a big test that's in play. Jerome Powell came out right about here and said, I won't raise interest rates, I'll lower them. He's been printing everything, expanding everything. And man, that has created the same type of correction here. But of course, we're not above this yet. And this is, again, a pretty important indicator or relationship. I think that's what's most important, because what we're looking at here is we're looking at how, and it's not just U.S. investors, but how 400 or 500 million people are, where they're voting. Are they voting stock market, line above, red line, or are they voting bond market, black line below? And it's right in that space now. Okay, so I think it gets a little bit more interesting, or I'm going to make it get a little bit more interesting. Let me look at my notes here to make sure I stay on track here. So here's something here. So I just looked at the S&P 500 with dividends reinvested, and that, I probably shouldn't have pulled this up yet, but the SPY, there's lots of different tracking symbols, but basically it's the S&P 500. It's the 500 biggest companies in the US. And it's a pretty big index. It's about $22 trillion market cap. Okay. The Nasdaq 100 is about a third the size. So the QQQs or the Qs, QQQ or the Qs, they are about 7.5 trillion. So they're a third of the size of the S&P. So if we called the S&P the broad representation of the US, then the Qs would be the broad representation of where the strongest part of the market is. Now, it's not necessarily always going to be the strongest part of the market, but basically what the Qs are, or the Nasdaq 100 is, it's the largest 100 stocks in the Nasdaq composite without financials. And if you've been in my world for any amount of time, I've been pounding the table that financials are not the thing to be looking at anymore. I believe they're dead as a leading indicator. They're getting eaten by technology. Same thing with energy. But what we have here, notice this. So this price chart here, now attention back to the price chart. We have the same barrier, right? So this price chart is being divided by the US bond market. But if you go from memory, the S&P spent a lot of time up here. Okay. But notice this with bonds. Bonds were creating a much bigger problem to the Nasdaq. Because remember, the S&P was up here most of the time, popped down here, popped up, popped down here. But this is interesting because now the Nasdaq 100 is above. It's poked its head up, and it's poked its head up here. So this is interesting. So the Nasdaq is creating a lot more strength. Now look, sorry, the Nasdaq 100. Now over the last 3, 6, 9, 10 years, the Nasdaq 100 has absolutely outperformed the S&P 500. But what I find interesting here is the Nasdaq is showing the strength which it's had in the past, right? So if you just bought the Nasdaq 10 years ago when the market bottomed and did nothing, you would have greatly outperformed, noticeably outperformed just buying the S&P 500. So the Nasdaq definitely got back on its feet. And look, this is a good sign because the Nasdaq, those 100 companies, that's all the tech companies, it's the healthcare companies, it's the ones that are really leading really the US and I believe the world ahead, right? It's the strongest of the strongest in there. And it's some companies you haven't heard of. But again, they went into this market strong and they're coming out of it stronger. So I find the Nasdaq 100, even though it's a third the size of the S&P 500, it almost represents the strongest part of America or the strongest part of the world even because look, if you live in France or Europe or Germany or Japan, you still have Facebook, you're still using Google, you're still using Apple, you still have Netflix, right? It still has those big ones in there. You're still using Microsoft products. Those are these huge companies that are representing this. But again, this is the NASDAQ 100 being divided by the bond market. So it's really interesting how the NASDAQ is broken above. Okay, a couple more things, then I'll hit the pause button here. I did get an email asking, it was an email just from Carl, one of the subscribers, saying he's concerned about his pension and his portfolio because of Treasury. So guys, I do not give financial advice. You know that. But here's what's interesting. Here's the corporate bond market in the US. And clearly you can see where it broke and where Powell stepped in and said, I will buy this. But I don't think Powell's going to bail out companies that fail or can't pay their debt. And so it's hard for me to give an answer right now other than this is a very scary looking price chart. This is the corporate bond market in the US. Like, I don't know what to say. Clearly it got bailed out, but is Powell going to bail out companies when they stop making their debt payments? Which when you stop making your debt payments, that's called a default. So I don't know what happens when large companies start defaulting and who bails out a large company. I'm hoping no one does and we allow capitalism to work its system. This is the total bond market index fund for the US. So this is just looking at the whole bond market in the US. And it looks, you can clearly see the collapse in the bond market. And it absolutely collapsed here. And it's just hanging out up here. Like, I'm so curious what it's going to do. That's a pretty tight range, everybody. This is a very tight range. The bond market is really figuring out, oh, is everything good? Like, is everything good? Like, we clearly had the crack in the bond market. Powell stepped in. But now it's like, what's going to happen? What's going to happen? And it's truly deciding. Municipal bond market right here, not looking as good. Did the same collapse here. It's moving back down. And then we have the inflation protected doing the same thing. So it's interesting. I still see the bond market as the place of concern. I am not worried as much about Treasury bonds. Things still worry me about this whole, oops, I mistyped that. If you look at the 10-year Treasury yield here, it definitely collapsed below 1.4%. And look, here's the deal. If this line goes higher, that's the bond market saying, okay, we think we're going to be okay. But the thing to think about the bond market, it's kind of more interested in you know, the future a little bit more. I mean, I even hesitate to think about it, but it's looking more like, okay, what's going to happen? What's going to happen? What's going to happen? And so, if you own bonds, personally, I think probably you're probably okay owning government um, over municipal bonds or corporate bonds because it's basically saying the government's going to protect you. But look, if the overall market starts not buying as much bonds, I don't think the Fed's going to come in and keep that yield down. I think the naturalness is when the yield goes up. I mean, not that, of course, when the yield goes up, the price goes down, and that could affect some people. So we've got a lot of instability here, guys. A couple takeaways that I want you just to get. There's still a lot of instability. We're really at a midpoint for the S&P, or kind of the big US picture, the big US stocks really fighting it out with the bond market. And it's right in that in between, figuring out what to do. The Nasdaq 100 is absolutely showing up stronger. It has shown up stronger over the last decade. It's smaller in size, right? So historically, you'd say, or traditionally, it's a more dangerous thing, but it's actually been a place of more stability over this time period than the larger, broader market. So things are absolutely changing. And it's going to be just so interesting to see what happens over this quarter when the country starts opening up. I just learned that Inslee says we have to wear masks and gloves when we go into retail places. So it'll be interesting to go out and see everybody in masks. It's like we're in a Netflix special. It's absolutely insanity. Guys, go ahead and click on the button right above the comments. If you're curious about how being over diversified is hurting you, I have a free video that shows you, in fact, it's being over diversified that really is the thing that's been hurting you. We're all taught diversify, diversify, diversify. But I think people start to notice I was diversified in 2000, I was diversified in 2008, I was diversified in 2020. Didn't really help, and didn't really help in the in-betweens. So I put a free training together called The Diversification Myth. You can just click the link above comments and it will take you there. Thanks, guys, for being in my world. Please subscribe, leave comments, forward it to a friend. You can leave comments on what you want me to cover, or you can email me when you get on my email list. It's super easy to do. So thank you for being in my world. You guys take care. And this is really just another step in helping you protect your portfolio and your future. Okay, guys, bye.